Uh, Now let's move on to decentralized applications. Now, for example, I'll start with like this. In this sense, I'll start in with what is DeFi. Like, what is DeFi? DeFi, pretty much in short, is decentralized financial systems. What do they mean by decentralized financial systems? For you to understand decentralized financial systems, again, you need to understand what financial services access are. In the basics, I'll just immediately go into the immediate ones. One, it is savings. Two, lending. So you lending out your money for some services. Three, and eight, literally, is borrowing. Now, in the basics of basics, financial services usually revolve around these three things: savings, lending, and borrowing. And then there are other ones which are slightly more advanced. Then we go deeper. Now, they're trading services, basically, e.g., forex trading. In cryptocurrencies, pretty much you can call them cryptocurrency trading. And then we have things like insurance. So basically, insure your money, insure your car, insure something. And then we have insurance. Okay, no, leave that alone. I'll go deeper into that later. Then we have something also known as synthetics. Now, synthetics is a pretty much advanced concept, but if you've come across, for example, DAI, which is pretty much a US dollar version flavor in cryptocurrency, that which one is made to it's literally made to it's a token literally made to represent the dollar one-to-one. The difference about DAI and other like US dollar flavors is that it is literally generated from Ethereum. So every one DAI is equals literally to 1.5 Ethereums. Something like that. Not a 1.5, but basically $1.5 worth of Ethereum. So synthetics are a bit complex in that sense. So synthetics basically are tokens of value that are created from a different asset. So you can use, for example, let's say you can take like 500,000 Kenya shillings, generate new tokens of the US dollar, and say they're backed by 500,000 Kenya shillings worth of Kenya shillings, and you create a synthetic. Why do people do this? I'll go deeper about them later when I get to them, because they're a concept in, I think they're the last concept for me to cover in DeFi. Now, I'm not sure. By maybe let me quickly ask. By maybe I don't know how I'll ask this is, how many of us maybe understand how literally banks work, like the underlying engine of a bank? Maybe, yeah. Actually, there's a raised hand. Okay, that's, I guess. People are free to unmute and say yes, yes, yes.
Yeah, people can just type or raise your hand.
Oh, yeah. Let me go to chat. Like literally the underlying engine. Yeah, yeah. I meant equity. I meant equity. Sorry, like I haven't a rough idea. Okay. So I guess it's good if I went through it slightly. Okay, so that you can actually now understand DeFi from the basics. Okay, cheers. Thank you, guys. So I guess from a quick yes votes or no votes is like, okay, a few understand, a few not so much, some a little. Okay. Okay, so I'll just break it down. I'll just break it down from here, just pretty quickly. So pretty much, it's very simple. It's just that I don't know why we usually think. I think we usually think it's very complex, but it's pretty simple. Okay. So how a bank basically works is literally there's you. who they require. Okay, so here's let me just put it at the center, bank. So there's you here. Let's say this is you or me, like Eugene. Then Eugene has like $1,000. $1,000. So Eugene wants to store his money in a very secure place. The bank says we offer you, Eugene, 6% interest rate per year. When they say that per year, if you've seen somewhere online known as APY, this is literally what they're saying. Annual percentage yield, which is basically, if I left my $1,000 in that bank within the year, I would actually live with around $1,006. Is it 6 or 60? I think it's around 60. Around $60. So I'll earn $60 within the year if I leave my money with them for the entire year. Now, the bank will literally take this money, and then on the other side, it will lend it out to, let's say, Kamau, a good businessman. This is a very badly drawn human being. This is something like that, yeah. So Kamau will borrow. Let's say, for example, Kamau will borrow maybe $5,000. He'll borrow from the bank. When he borrows from the bank $5,000, he'll borrow at a paying back interest rate of roughly 12%, or sometimes slightly more. Remember, also this is APY, or you can just call it interest rate. So it's either APY or interest rate. Now, as you can see, Kamau will borrow $5,000. The bank has something known as fractional reserves, where for every $1,000 they actually take in, they can actually lend out, I think, up to 10 times more of that same amount. Technically, it's not allowed. Okay, you can't say it's completely legal because it doesn't make sense. Because if I gave my bank $1,000, you can ask me, where did $4,000 come from? And so this is called fractional reserve banking, where banks are actually allowed to lend out more than they actually have. Usually, actually around 10 times more than they actually have. So they can actually lend out up to $10,000 for every $1,000 any user stores with the bank. Okay, so but the key point here is, remember, Kamau took the money at 12% interest rate. I gave the bank. The bank said they'll give me 6% interest rate for as long as my money stays with them within the year. Now, when Kamau comes back and pays the money, so I think he'll come back and pay the money at around, if it's 12, I'll get lost a bit, but let me do the maths quickly. Okay, so within the year, if Kamau pays the money back within the year at 12% interest rate, he'll pay back at 5,600. So this is what he'll pay back, and then somewhere. So let me just migrate this one here, and then I'll personally make $1,060. Okay, so when Kamau comes back and pays back the money, he'll pay back the money within the year at 5,600. Now the bank will take the $600, take out $60, and give me back give me back the $60. I mean, basically pay me back $60 as a thank you for actually allowing my money to be lended out to other people. Now the bank, even if it was still $1,000, the bank would have made $120, and what would have happened is that the bank would keep the $60 for every $1,000. And then the other $60 they would give it back to me, and that's literally how a bank system makes money. There are other financial instruments, but in the basics of the basics, that's literally how a bank makes money. They take your money, lend it out at a higher interest rate. The margin between, they make the money back. They make the money back. Now, if we go to decentralized finance, somebody discovered, or basically people discovered, a way of actually creating the same system, whatever I've talked about right now, without any human being involved. Remember, when you give them money, you have to track it using an application. When Kamo is borrowing, they actually have to write application letters. They have to maybe give a collateral, show they can actually pay back the money, maybe through their salaries and something like that. But in Ethereum, we don't have that. So it's completely decentralized. There's no human being involved. So somebody figured out literally how to make the entire system without any human being involved. So pretty much is I would give the system my money. So one of those examples is actually called Compound. Compound is actually literally a decentralized bank. Compound Finance. I can take you to that. But pretty much is using my Ethereum address. So maybe that's 0x75 is I'd literally deposit my $1,000, but remember it's in token format, so maybe as DAI, and then somebody else would borrow that amount of money to using their own address. Maybe I don't know, maybe 0x SA blah 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 blah, and then they borrow the same $1,000. That's pretty much written wrongly. Something like that. Yeah, they'd borrow the same $1,000. Now remember, I'd give the same system because the Compound system is built on a blockchain layer using smart contracts. The system can mimic the bank entirely without any human being ever being involved. You just deploy the system. So usually they are called protocols. Because they do not require any humans to manage them, they're called protocols. So you'll hear about so much about protocols in the Ethereum ecosystem. So the Compound banking protocol basically allows the borrowing and lending of money automatedly without any human being ever involved. And then it automatically also calibrates itself depending on the demand and supply. If there's too much supply, the interest rate lowers. If there's too much demand, the interest rate also increases itself. If there's too much money which has been lended out, also the interest rate stays high, so the people can actually pay back, and then the system does that automatically. And that's one example of a decentralized financial system. Now I'm going to go deeper and explain the incentivization, which is actually it was introduced by a different company known as Synthetics, but basically Compound made it mainstream.